So it looks like the market took a page out of Fat Joe's playbook in August, as it has been climbing all the way up. I mean, just in the last 30 days, the Dow has jumped up over 4%, the S&P nearly 6%, and the NASDAQ a whopping 7%, which means we dividend investors have to bust out the shovels and really start digging if we want to find some discounts. Luckily, I've stumbled upon 3 rock-solid dividend stocks whose share prices are still plummeting despite what the rest of the market is doing, and in today's video, we're going to be talking all about them and why they may be good buys in the month of September. So without further ado, let's get into it. Alright guys, now just so you know my criteria in how I went about choosing the stocks for today's video, I'm looking primarily for 3 different things. Number 1, I'm looking for a negative share price performance. I want to see the stock share price going down both in the last 1 month period, in the last 30 days, and also year to date. I want to see a negative share price performance. Now, a negative share price performance could increase the chance that these stocks are at an attractive valuation, which is the next thing I'm looking for. I'm in search of a low PE ratio or a low price to funds from operation, a P to FFO in the case of one of the stocks we're talking about today. And the last thing I'm looking for, of course, are solid dividend stats. This means, a somewhat decent dividend yield. Doesn't have to be anything too crazy, not too low, not too high. I'm looking for a decent payout ratio on the lower side, preferably. I'm looking for a nice 5-year growth rate, see that dividend growing, and also nice dividend growth history. And all of the stocks in today's video have one or some sort of combination of each of these qualities. Now, the first stock I want to share with you today is one that we've covered a handful of times on this channel this year, as it has just really been plummeting all year long. We're talking about Stanley Black and Decker, ticker symbol SWK. Now, 2022 has not been nice to this stock share price. As you can see, year to date, they are down over 50%. That's right, guys. We are seeing a half-off discount of Stanley Black and Decker in 2022. And just in the last 30 days, guys, they're down 18.5%, almost 20% just in the last month. So this stock is just cratering. Now, from what I can tell, there's a couple reasons this stock has been on a steady decline all year long. If we go back to the screen real quick, Stanley Black and Decker has fallen short on their last 3 earnings report, at least here on the top line as far as revenue goes, they've missed. And according to an article I found here on Seeking Alpha, they have seen less sales come in due to demand weakness combined with the commodity headwinds that have been going on. And the demand weakness in itself explains why we're seeing this top line miss the last 3 quarters. I mean, people just aren't buying their products as much. And this is for a couple of reasons. Either number 1, they figure it's not worth the price that they're paying for them, or number 2, they're opting to buy from some of Stanley Black and Decker's competitors. And to add insult to injury, when people do buy Stanley Black and Decker's products right now, the profit margin is lower due to the aforementioned commodity headwinds. And all of these things, when combined together, are pushing this company's share price down, which could be creating a buying opportunity. I mean, like we saw a moment ago, they're down 50% just this year. And if we go over to the valuation page, we can take a look at their PE ratio, which is really not too bad. 17.19 for the forward PE ratio, which admittedly is a little bit higher compared to the rest of the sector by about 3.5%, but it is just a skosh lower than this company's 5-year average PE ratio of 17.58. So I guess there still is plenty of room for Stanley Black and Decker to come down, which they might if they continue on the same trend, but still a 50% reduction in share price is nothing to stick your nose up at. Now, moving on and getting into the dividend stats, the forward dividend yield is pretty average, 3.32%, not too bad. They have a payout ratio that is very low, 36%, which could indicate some sustainability and security for the dividend, so that's really good to see. The 5-year growth rate is pretty moderate, about 6.4%, and they have a really nice dividend growth history. 53 years of dividend growth, making Stanley Black and Decker a dividend king. All right, my friends, now moving on to the second stock of the day, we are talking about Medical Properties Trust, ticker symbol MPW, which is a real estate investment trust. And like Stanley Black and Decker, this stock is heading south and is heading south quickly. I mean, year to date, as you can see, they are down 35.35%, pretty big drop. And then in the last month, they are down 9.65%. So seeing some pretty substantial losses in the last 30 days. I really couldn't find much to explain why MPW was down so much this year, except for one Seeking Alpha author who says that the compression in their share price is a result of management failing to keep up with analysts' expectations, which I guess the relevance of that depends on how much importance you place on the opinions of analysts. And additionally, it appears that their biggest tenant has been giving them some trouble as well, which has had a negative impact on this company's share price. And my friend Mark Rusin, who has a really awesome YouTube channel, I highly recommend you guys check it out. He actually explained this all to me in a comment on one of my recent videos. He says, MPW is a much higher risk option. They have a short report out on them that has added pressure to the stock as of late. The concern is around their exposure to their largest tenant, Steward, who has had some cash flow issues. The issues got worse, and MPW ended up making a loan to Steward in the last quarter, but that is expected to be paid back in full shortly. Definitely something to keep an eye on with MPW, but I do have a small exposure to them. Now, moving on and getting into MPW's valuation, as you can see at the top of the screen right there, Seeking Alpha is giving their valuation a grade of A+, which is, you can't beat that, obviously, guys. And we can see the PE ratio right here at the top is looking good, but because it's a real estate investment trust, we don't really care so much about the PE ratio. We're really looking more at the price to funds from operation, the P to FFO, and we can see that their P to FFO is 8.46 in the single digits, which is very, very nice. So you combine its negative share price performance with this really sweet valuation, and it does look like there's a little bit of a buying opportunity here with MPW. Now, getting into the dividend stats, guys, as you can see, they have a really high forward dividend yield, 7.5% for the dividend yield. The payout ratio, we won't pay too much attention to because this is the earnings payout ratio. We really want to see the FFO payout ratio, which is not on this page. But moving on to the 5-year growth rate, guys, 3.93, nothing too crazy. There's a little bit of growth going on, but more than anything, you're buying this for the high starting yield, right? The dividend growth history is not too bad, though. 9 consecutive years of dividend growth. Now, moving on, getting into the third and final stock of the day. You guys are going to know this one. We're talking about Pfizer, ticker symbol PFE, who, just like the first two stocks, guys, not great share price performance. Year to date, they're down 16.5%, with a lot of those losses, half of those losses just coming in the last month, where they're down 8.83%. And I'm sure it comes as no surprise to you guys that Pfizer was a huge beneficiary of the COVID pandemic. And as you can see from this revenue chart right here, their sales just skyrocketed in 2021, basically doubled what they did in 2020, 2019, and 2018. And what I think is going on and why we're seeing this negative share price performance is as we move out of the pandemic, get back to normal, the market is starting to price in Pfizer's return to homeostasis. They think a lot of those inflated sales are behind them, and moving forward, we'll start to see sales kind of go back to where they were before the pandemic. Additionally, the recent passing of the Inflation Reduction Act, whose goal is to curb inflation by reducing drug prices, amongst other things, isn't necessarily the best news for Pfizer either, which also contributes to the stock's diminishing share price. But guys, the silver lining in all of this is right now is a fantastic time to buy Pfizer. Taking a look at the valuation, their forward PE ratio is 7.38, the lowest we've seen all day. And this happens to be about 62.5% lower than the sector median PE ratio and is about 40% lower than this company's 5-year average PE ratio. So both compared to other stocks in the healthcare sector and compared to Pfizer on a historical 5-year average, it looks to be just at a much more affordable valuation. And real quick, talking about the dividend stats before we get into the yield and stuff like that, just take a look at the dividend grade that Seeking Alpha is giving Pfizer. It all looks really good. B- for safety, okay, that's their lowest grade, but dividend growth, dividend yield, dividend consistency, all are given A's or A+. Now, scrolling down, taking a look at the forward yield, 3.34%, not too bad, and that payout ratio could not be better. 26% for the payout ratio, very low, very sustainable, with a 5-year growth rate at about 6%, which is pretty moderate, and a nice dividend growth history of just over double digits, 11 years of consecutive dividend growth. But if we go over to the dividend history page, we can see that they've actually been paying the dividend for 32 straight years. And then zooming out on this chart right here, it looks like they cut it back in 2009, and then they've been just growing it back ever since. All right, guys, now with those three behind us, I want to do a little rapid fire and go through a handful more stocks that I think you need to keep your eye on as we head into the month of September, because there could be more discounts on the table here. Starting with this first one, which is Qualcomm, ticker symbol QCOM, who in the last month has seen a really big drop, 7%, and then year to date, they're down about 24.25%. So seeing some discount there. The next one to keep your eye on, guys, some of you will like this one, some of you will not. We're talking about Intel, ticker symbol INTC, who has also had a pretty rough year, down 36.25%, and then in the last month, they've seen a huge drop, down 13.7%. Another stock seeing just a fat decline is Scott's Miracle-Gro, ticker symbol SMG, who is down about 55.8% year to date, and then in the last month, they've also seen a really hefty drop, down 14.3%. Next up, guys, keep your eye on VF Corporation, ticker symbol VFC, who is down about 43.5% year to date, and then in the last month, they're down nearly double digits, down 9.9%, so definitely some discount action going on there. And if you look at the right-hand side of the screen, VFC is tickling that 52-week low, and it's actually like right there. It probably hit the 52-week low today. And lastly, guys, keep your eye on Verizon, who is down 17.35% year to date, and who is down nearly 3% in the last 30 days. Anyway, now that you guys are clued in on some of the best dividend stocks to take advantage of right now, check out this next video to learn about 23 dividend stocks that will be paying you a dividend in September just for being a shareholder. So click right over here, and I'll see you in the next one.